Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. Credit spreads over the last week have been suggesting that credit risk in the market is rising substantially. We also just got data from the Federal Reserve that gives further evidence that credit markets are likely to deteriorate in the coming months. So why is the stock market not reacting to this news? Why is it holding up? That's exactly what we're going to take a look at in this video. Don't forget to smash the like button if you enjoy this video, if you learn something new. It is very much appreciated. And of course, subscribe to the channel if you are new here and you want to stay up to date on what's happening in the markets. Now, I have a quick announcement to make. We are giving 1 month of free access to our service to anybody who signs up on our website. Our aim with this service is to provide you with a complete macro strategy to give you an edge in the market, give you trade ideas that actually outperform, and of course give complete guidance on these investments. Basically, the service that I would have liked to have when I was starting out on my investment journey. And we're doing this deal to make sure that everybody can test out the service and see what it looks like completely for free. So make sure to click the link down below to take advantage of that deal. It is a limited offer, so don't miss your chance. Now, this is a chart of option adjusted credit spreads. This is one of the ways that the market prices in credit risk, default risk in the market. You can see spreads tend to rise when you have increased risk in the market. You can see leading up to recession and during recessions, you see credit spreads spike. And as you see strong economic growth or an economic recovery, you tend to see credit spreads tighten or decline here on this chart as credit risk goes down. And they can be very good leading indicators of the stock market. And I'm going to show you exactly why. Let's invert this scale here. So you can see this is the same chart, but on an inverted scale, and you'll see it looks a little bit like the stock market. I add the S&P 500 on top of the chart, you'll see credit spreads and the stock market move in the same direction. And that makes sense. As there's less credit risk in the economy, well, you tend to see investors get optimistic and invest their money in the stock market because there's less risk. Now, what's been happening more recently, what I wanted to show you in this video, is that we have seen credit risk and the stock market move in opposite directions more recently. So you can see here, obviously, the stock market has been strong. We've seen the rally hold up very recently. And meanwhile, you look at the credit market and it's heading in the opposite direction. So this can be considered a warning signal. We're going to take a look at the track record of these types of divergences to anticipate drawdowns in the market. But right off the bat, I just want to say, this is not typically what you want to see during a bull run. You can see, for example, here in 2021, you had the market move higher between June of 2021 and December of 2022. And meanwhile, you had credit risk actually increase in the market throughout that period. So a similar type of divergence that actually ultimately led to the top of the bull run here before the 2022 bear market. Now, of course, keep in mind here that these divergences can last quite a significant amount of time. This divergence started in June of 2021 and ended in December of 2021. So this lasted 6 months before it actually played out for a top in the market. Sometimes it's a lot more brief. You can see here in 2019, credit markets were already sniffing that something bad was going to happen, yet the stock market was completely disregarding that risk. So very near-term divergences here, credit risk flashing a warning signal right before the big crash. So that's 2 successful examples where credit risk did anticipate the top, one very near term, one took 6 months to play out. Now here in 2019, you can see credit risk was also rising, but the stock market was still being optimistic, and this did not play out for a correction. So this is an example where you actually didn't see this type of divergence play out for a correction. Eventually, you actually saw credit risk decline again later in 2019. But I think the most fascinating example is really in 2008 here. This is 2008 leading up to the all-time high. October of 2007, the market makes a double top type of pattern, look at what credit spreads are doing. They're moving in the opposite direction, telling you credit risk is rising substantially. This also happened in 2000, where leading up to the top, and this actually lasted for a very long time, these divergences leading up to the top in 2000, look at what credit spreads were doing. They were warning you for a couple years in advance that you were going to see that risk was rising substantially in the market throughout that period. But you also had this type of divergence anticipate shorter term corrections like 2011 here. Credit risk rising right before the correction. Same thing here in 2015. Credit risk rising right before a big double dip type of correction. So you can see these vary in time, in length. The divergences can last a long time. And also they don't necessarily always work out. So of course, take this with a grain of salt, but in general, credit risk right now with the banking crisis is rising and the stock market is not taking that into account. So I think that dynamic is definitely worth noting right now. Now, of course, for a bear market to actually play out, we need to see credit risk deteriorate much more significantly, a little bit like it did here in 2000, in 2008, during COVID. You actually need to see a big panic move in these credit spreads in order for the market to really get concerned. And we actually did just get data from a Fed survey that tells us that this may actually happen. I'm going to show you that in just a minute. Don't forget to smash the like button, by the way, if you're so far enjoying this video. But before we actually look at data that suggests that this is potentially going to continue moving down in the months ahead, let's first compare this type of behavior in the credit market against moments where you actually did see powerful recoveries in the market. What were credit spreads doing at those moments where you did see strong market recoveries like 2000, like 2008, like 2012? And is this in any way comparable to what we saw in those big recoveries? Let me put a couple of moving averages on this chart so that you can understand the momentum that we have right now. You can see the slower moving average is pointing down. Credit spreads are below the 100-week moving average, and the 20-week moving average is below the 100-week, and it's also pointing down. So very weak momentum that we have right now. If we look at previous recoveries in the market that were very strong, that really showed a lot of momentum, like 2003, like 2009, 2015 here, and 2021. These recoveries saw credit spread momentum really shift in the opposite direction, really see a strong recovery. Same thing here in 2009, big recovery in credit spreads. What we're seeing today in terms of momentum looks a lot more like perhaps what was going on here between March 2019 and January 2020. Same thing here. Momentum looks very weak throughout this period. In 2015, credit spreads never go above the 100-week moving average. If we zoom out a little bit more, this looks similar. Now in 2002, you had this type of quick whipsaw signal here. But in general, if we look at similar moments in terms of credit market behavior, you can see that typically performance in the stock market after this type of behavior isn't too good. 2019 before the COVID crash, 2015, 2001 here, 1999 here. So if you want to be optimistic on the market today, you really need to see this look improve significantly. And it very well could. If you see a significant improvement in the situation with the banking crisis, you could see a big breakout here, especially if the Federal Reserve begins to ease monetary policy, inflation comes down rapidly, the economy holds up pretty well. You could see this type of big recovery in credit markets. Right now, as we speak, it doesn't look like this is what's happening. It doesn't look like we have a very strong recovery, and we should be expecting the stock market to move much higher in the near future. And this is the last chart that I want to show you regarding the credit market. We just got this week a very important data point from this data set. Now, this orange line here is telling us how much banks are tightening or easing lending standards. You can see when this orange line is going down, it means lending standards are very tight. Banks are not at all lending money. And that's exactly what happened leading up to the dot-com recession. It's what happened leading up to the 2008 recession. And just in general, when banks are not lending money, you typically see a deterioration in credit markets. Now, by the way, this is just a survey from the Federal Reserve. So they just go and ask banks, are they lending money or not, right? So it's not market data. The credit spread is actually what the market is pricing in. You can see there are periods of time where you have a divergence between what the market is pricing in and what the reality is in the banking system that's represented through these surveys. And you can see here that's exactly what we've had more recently, where these surveys that are collected by the Fed are saying that banks are really tightening their lending standards. We have the tightest credit system that we've had really since 2008 and 2001. If you exclude COVID, that was a very unusual moment in the market. You can see this most recent data point shows even further tightening in lending standards and not at all an improvement in the situation with credit system. Now, of course, if next quarter, if we see a massive improvement in these lending standards from domestic banks, maybe that justifies, after all, the market was right to never price in these tighter lending standards because banks are lending money again. With this last data point, that's not what we're seeing. Banks are still tight and they're not looking to loosen. The Federal Reserve is not going to cut rates anytime soon unless you enter a recession. And in a recession, you tend to see these lending standards get even worse and these credit spreads to really deteriorate. So of course, you want to stay data dependent on this, but the big divergence that we're seeing here in terms of what the market is pricing in versus what these Fed surveys are suggesting, that's a concern. We would really want to see these Fed surveys see a big improvement before we can get optimistic about the market. It's very difficult to imagine a scenario where you have a lot of strong economic growth, an improving situation with credit without seeing these banks really begin to lend money. So that's what I wanted to cover in this episode. I hope you guys enjoyed this video. If you did, don't forget to smash the like button. And of course, subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.